Let us look at how to include growth and dividend stocks in a well-balanced portfolio. How to, include growth stocks as well as some dividend stocks in a typical well-balanced portfolio. A balanced portfolio typically combines different asset types to reduce the risk and enhance potential returns. It's there mainly to reduce risk as well as enhance returns. So including both growth and dividend stocks in your portfolio allows you to achieve a mix of capital appreciation, through growth stocks and steady income through dividend stocks. So this is how it is done. This is how to incorporate both in a typical portfolio. Number one is understand the difference between growth and dividend stocks. You need to first of all understand their differences before you not think of including them in a portfolio. Number the first item there is growth stocks. Growth stocks. These are companies expected to grow faster than the market. They grow at an above average rate. Often reinvesting profits to fuel expansion rather than paying out dividends. They offer higher potential for capital appreciation, but they come with more volatility. Good. Let's look at dividend stocks. These are companies that pay regular dividends to shareholders, often from stable cash flows. They provide steady income and tends to be less volatile, offering stability to your portfolio. They help to stabilize the portfolio and as well as provides regular income. Number two is you allocate based on investment goals. You carry out your allocation based on your investment objectives. So in this case, if you are growth focused, you are kind of a growth focused investor. If your goal is long-term capital appreciation, allocate a higher percentage of your portfolio to growth stocks, especially if you are young and can afford to be more risky. Generally, growth stocks tend to be more risky compared to dividend stocks. And if you are income focused, you want to obtain regular income. So if you are looking for income or are closer to retirement, increase your allocation to dividend stocks for more predictable cash flow and stability, because dividends guarantees you cash flow whenever they are paid. Number three is you maintain a balance. Maintain a balance. So in this case, you diversify across sectors. Diversify across sectors. You diversify across different sectors like technology, like healthcare, like consumer staples, like retails. Diversify across all those sectors. You may equally include utilities and the rest. You diversify across them. Not only that, you may diversify by market capitalization. In that case, you may include large cap stocks, large cap dividend paying stocks that will guarantee stability, or small or mid-range, growth stock, mid cap, small caps, and growth stocks for higher potential, for higher potential growth, for higher growth potentials. So this also a very important way of maintaining a balance. Diversify across sectors and also diversify by market capitalization. Number four is consider a hybrid approach. Consider a hybrid approach. Please don't forget to like this video and subscribe to this channel. It doesn't cost you anything to just press the subscribe button and you like the video. within seconds you are through. It doesn't really cost you anything. So consider a hybrid approach. In this case, dividend growth stocks. You may consider dividend growth stocks. These stocks offer a mix of both growth and an income. They provide reliable dividends that tends to increase over time, often from companies with solid growth potential. These companies are growing rapidly at an above average clip, and at the same time, they are providing dividends. It's a wonderful kind of characteristics. So you may also look at a balanced fund. Balanced fund. So consider funds that combine growth and dividend stocks, offering exposure to both styles, while maintaining diversification. In this case, you consider style as well as dividends and growth. So in this case, you have a balanced portfolio. Your portfolio is growing, and also you are equally having regular income. Number 5 is adjust over time. You don't just invest and go to sleep. No, you should be wide awake, making adjustments here and there based on market conditions and company performance or the constituent company performance in your portfolio. So there is this life cycle adjustment as you approach retirement, or your financial goals evolves. Gradually shift your portfolio to include more dividend stocks for income and less growth, and less growth focused stocks. You lessen, your priority, on you reduce your attention, your focus, or your allocation to growth focused stocks and concentrate on dividends paying stocks. So you rebalance regularly. Rebalance your portfolio periodically to ensure it aligns with your goals, risk tolerance and the market conditions. Not only that, growth stocks might outperform in a certain market conditions. So adjust the allocation to maintain your target balance. The need for regular adjustment to maintain balance, an appropriate balance in the portfolio. Number 6 is monitor and review. Monitor and review. So in this case, you consider performance tracking. You incorporate performance tracking to monitor the performance of your growth and dividend stocks to ensure they continue to meet your objectives. So adjust if necessary based on changes in the markets, or your financial situation. So as you monitor, you adjust, and you don't adjust without performance tracking. You track the performance of the constituent assets in your portfolio and carry out adjustments wherever necessary. So in conclusion, by carefully rebalancing growth and dividend stocks in your portfolio, you can achieve both capital appreciation and income, as well as income generation.